The fear of missing out is real. And there's nothing worse than seeing the people around you make a bunch of money and, it seems you're stuck in this quote unquote boring plan.
Welcome to Blind Spots, a podcast where we're helping you fill the gap between what you want to do with your money and what you actually do. We are professional investors, writers, and financial planners helping you navigate the complexities of finance to optimize what you can control and cut out the rest. Join your host, Nik Schuurmans and Erin Varghese, as we discuss the questions and nuances surrounding everyday money management. Investment advisory services offered through Pure Portfolios, a registered investment advisor with the U.S. Securities and Exchange Commission. Nik Schuurmans and Erin Varghese work for Pure Portfolios. Any opinions expressed by Nik and Erin or any podcast guest are solely their own opinions and do not reflect the opinions of Pure Portfolios. This podcast is for informational purposes only and should not be relied upon for investment decisions. It should not be construed as legal or tax advice and is not intended to replace the advice of a qualified attorney or tax professional. Clients of Pure Portfolios may maintain positions in securities discussed in this podcast. This information is not an offer or solicitation to buy or sell securities. The information contained may have been compiled from third-party sources and is believed to be reliable. Hello everyone and welcome back to Blind Spots. Today we are talking about the mindset shift that happens between your working years and retirement. We are also going to be discussing the story of a man who amassed a wealth of over $8 billion and lost everything in 10 days. And then we are going to talk about how we see that manifesting in the day-to-day lives of retirees.
Yes, and to be clear, Erin, it's the mindset shift that should happen, but often doesn't. So in our opinion, the skill set and the mindset for building wealth and keeping wealth are completely different. So we're going to get into that, what that looks like, the subtle shift that can make a big difference if your retirement is a success or a failure, and ways that manifests itself. So what the subtle shifts in mindset look like in practical terms.
So when thinking about the difference between a wealth building mindset and a person who is content, what does the typical wealth building mindset look like?
So the wealth building mindset is basically the mindset that you have when you're working, right? You're focused on saving, maxing out your 401k or maxing out your IRAs. You're seeking risk, and that could manifest itself by starting a business or investing in real estate or taking on debt or building wealth through the equity markets. You have the relentless pursuit of more. You're trying to build your balance sheet. And this is something that we all can relate to. It's the American dream. It pays to be a patient optimist in this country, and risk, if you're smart and you're measured, has been rewarded in this country.
So after doing that for years and years and years, as we typically do while we're working, what are the typical characteristics of someone who is either close to retirement or they are retired and they are content and have, maybe as we've referenced before, found their enough?
Well, I think there's two things here. There's the tangible things that you do, right? So it's not uncommon for someone who's worked for 40 years, is on the cusp of retiring, to maybe downsize their home or position their investment portfolio a little more conservatively. Like, these are all mental shortcuts that maybe aren't optimal for everybody, but most people do them or know about them. So that's one thing. What people miss, and where the gap is the mindset shift, right? You've just spent 50 years in wealth building mode and risk seeking mode, whatever that looks like for you. And now suddenly you need to turn that off. Maybe you have enough. Maybe you've saved and done a really good job, and you've run a financial plan and everything checks out. But if you're still stuck in that risk seeking mindset, that is a blind spot which could derail your plan. So while you might have done the physical things, or tangible things, I should say, to better prepare yourself for retirement, if you're still stuck in the wealth building mode, and we'll talk about ways, real life examples of how that shows up, you are your own worst enemy. And we've said time and again, doing things where the best case outcome won't change your life. Like, if you have a portfolio that's $5 million, you've run a financial plan, it's airtight. If you take that 5 million and turn it into 7.5 million by taking risk, that's probably not going to change your lifestyle. But if you take that $5 million and turn it into 1.5, because you are still stuck in this growth, risk-seeking mindset, the relentless pursuit of more, that will adversely affect your plan.
Yeah, absolutely. And we've seen this time and time again throughout history of either families or individuals who have more than enough, more than probably most people could ever imagine, and they've turned it into almost zero. So tell us about Bill Wang and his story.
This is probably the most spectacular destruction of wealth that I can remember, certainly in my career. There's been countless others, but Bill Wang started his own family office. He built his wealth in the hedge fund industry by being a successful investor, managing other people's money. He was so successful that he had built a fortune of his own and opened a family office. So that means you're not managing outside money, you're managing your own family's money. And a typical family office might be anywhere from $1 billion to $100 billion and beyond. And the benefit of managing a family office is you're really not subject to outside scrutiny. You're not regulated, basically, or the regulation is very limited because, again, you're not managing the public's money. So the SEC and some of these big regulatory bodies don't really care what you do with your own money. Sure, it needs to be legal. But so Mr. Wang ended up borrowing, and Mr. Wang's fund managed $10 billion, give or take, of his own family's money. He ended up borrowing more money from a handful of banks, taking on leverage. So he took out loans from these big banks and invested in a concentrated stock portfolio. And I believe there was 10 or 12 names. Long story short, those names went against him. Those positions moved down and he lost money. The banks wanted their money back because the collateral backing those loans was worth a lot less. And Mr. Wang was forced to sell basically everything to pay off the loans. So in a span of 10 days, Mr. Wang destroyed $8 billion of wealth.
And when you talk about concentrated positions, 10 to 15 names in a $10 billion stock portfolio, that's pretty intense.
Well, and it's not the worst sin to be concentrated, but there was no risk management controls. Like usually if like famous investors that have concentrated bets, usually they'll have stop losses. Say if you bought a stock at 100 and it goes to 85, you automatically sell. But someone was asleep at the wheel because what happened should never happen. But it's a classic example of Mr. Wang and his family office. They could have checked out and done pretty much everything. I mean, he could have taken $100 million out of the bank and blowtorched it and still been fine. What he did was reckless. He was not content. He was still in the mode of risk seeking and the relentless pursuit of more. And it ended up blowing up his family from a financial standpoint.
So obviously being in that position with tens of millions of dollars, most people can't relate to that because it's wow, if I even just had $1 million or $2 million, I would be set for life. So Bill Wang's story and many others are an extreme type of example, but how do you see these same behaviors manifesting in the day-to-day lives of retirees?
Right. So if you haven't listened to our last podcast or read the blog about finding your enough, I think that's worthwhile to go back and listen to, because once you find your enough, you can turn off the risk-seeking mindset. Okay, so once you run your financial plan, you stress it for lower future returns, a bad market event, increased spending, a healthcare event, whatever you're worried about, bulletproof your plan and run all these scenarios to understand if you are on the right path. If you are on the right path, you found your enough. Okay, so once you find your enough, you shouldn't be shunning bonds in favor of 100% equities. You shouldn't be trying to beat the S&P 500 year in and year out. You shouldn't be upsizing your home or taking on debt to build a bigger home or buying a second home. You shouldn't be helping your kids buy a business or taking out a loan to help your kids buy a business. These are all things that are still in the wealth building or risk seeking mindset. And if your plan is favorable under one set of circumstances and you go off and keep doing these types of behaviors, your risk of ruin goes up. And the payoff, again, Bill Wang's an extreme example, but the payoff, if you take your, let's say your enough is $1 million and you take that and make it 1.5 million, that's great. It's not going to change your life. But if you cut that in half, now we're talking about going back to the drawing board, adversely affecting your lifestyle or changing your lifestyle.
Yeah. And we always talk about the need to be bailed out by the financial markets is the opposite of an empowering place to be. And people kind of get stuck in that.
Yeah. And I've had people who have found they're enough. They have a portfolio that's 50% stocks and 50% bonds, and they're upset or they're not content with a 10% return. Like they think they should be able to beat the S&P, and they have a feeling of missing out if their 50-50 portfolio does not beat the S&P. Now maybe I'm doing a poor job of framing expectations and setting a realistic return assumption, but that mindset exists. People feel like they're missing out when their portfolio is not achieving the return of 100% equity benchmark.
Yeah, and we talk about people anchoring to weird biases, and I think that that's probably pretty close to top of the list of comparing your portfolio that is not all equities to the benchmark that is.
Yeah, and another way I've seen this come out is, we're stacking up our 12th year of U.S. large cap stocks or U.S. markets in general being pretty good. And what I found is people that are usually conservative investors starting to get a little antsy and perhaps want to lean into more risk, maybe increase their equity exposure because their neighbor who's instead of a 50-50 investor, their neighbor might be an 80-20 investor. And the 80-20 investor is telling the 50-50 investor how good it's been the last couple of years. So it creates this, FOMO is real. Like, that's kind of a thing for the crypto space, but the fear of missing out is real. And there's nothing worse than seeing the people around you make a bunch of money and, it seems you're stuck in this quote unquote boring plan. But again, what's true for your neighbor is not true for you. We all have different experiences that shape the way that we view money. We have different plans, and circumstances, and family dynamics, and lifestyles, and yada, yada. So it's easy to get sucked into that game. So we've talked about the persona of someone that's in wealth building mindset, right? Taking risk, maybe starting a business, taking risk in the equity markets. What is the mindset of someone that is content, that has found they're enough, that is happy with what they have? They're not trying to grow their balance sheet. They're basically sitting on their rocker, sipping on their IPA, and they're content.
Not worrying about what the market is doing on a day-to-day basis.
Yeah, so they're not worrying about squeezing out an extra percent of return by adding equities. They understand the role that bonds play and other diversifying assets play in their portfolio. Maybe they've hired a independent advisor that's a professional that's handling the day in and day out, watching financial markets, rebalancing the portfolio, and they're fully immersed in their life. They're checked in with their grandkids, their family, or their kids. Maybe they're focused on their passion hobby, but they basically accepted their current financial lot. They can look back at their career with confidence, and they're happy with what they've built. They're not trying to grow their balance sheet anymore. And it's a subtle mindset shift, but it can make a huge impact whether your retirement plan is successful or not. In previous experiences, we've worked with folks that are perpetual tweakers, and this is another way that the growth mindset or the wealth building mindset shows up. Like they're constantly tweaking. Like, what should we be doing different in the investment portfolio? I'm thinking of buying a second home. I'm thinking of buying a rental property. I'm thinking of investing in this commercial real estate project. I'm thinking of buying a home for my son because his house is too small. It's like all of these things, maybe in isolation, are not a big deal, but when you stack them on top of each other, that is a self-sabotage. And the only way your plan can blow up is if you keep doing these things. This is another way that the wealth building mindset shows up. The constant activity, the constant tweaking, the constant doing stuff. Just stop doing stuff. I've said it time and again. People are their own worst enemy. A lot of folks stress about the global economy or what a politician is doing or tweeting. It's like, that's stuff that you really can't control. Yeah, if you want to pay attention to that, sure, it's entertaining. It might provide you some stimulus, whatever. But at the end of the day, you can't control that. You can control the way you think and what you do. And for most people, they want to err on the side of action. I would argue err on the side of doing nothing.
Yeah, I think because we've been conditioned for years and years and years to continue to build, to continue to grow your wealth, like you've mentioned, in the pursuit of more, it's really hard to just turn that mindset off. So for someone who's listening and they're really resonating with, okay, maybe that is how I think, or that's how I've been conducting myself, what should they do?
Well, one, and I think you said it, this is a subtle shift in mindset. It's not always obvious. So I think if you have some of the characteristics that we've outlined of always wanting to do something, continuing the pursuit of building wealth, you need to have some self-awareness and say, okay, I'm probably guilty of doing that. I've run a financial plan. I have more than enough. I probably need to take a step back. Two, once you realize that, you need to start to live it. So it's one thing to say something. It's another thing to actually do it in practice. So stop following the financial markets. Be content with what you have. Quit looking for opportunities to grow your portfolio or balance sheet or expand your real estate portfolio. And then the third thing, I would just say, if you're prone to doing stuff and you can't help yourself, then hire someone to do it for you and completely check out, or just err on the side of doing nothing. I mean, what I've been telling people that keep wanting to do stuff and that have more than enough, boring is good. I mean, we're coming off the craziest year since I've been alive in 2020. 2021 has been basically a dream compared to last year. I know we're still dealing with the COVID thing. I'm speaking strictly in financial market terms. Boring is good. Doing nothing is good. Now's a great time to do nothing, actually, because you look at the value of the markets and real estate. You can argue things are maybe a little disjointed and uneven or unbalanced, or however you want to say it. But boring is good if you're retired, and doing nothing is good.
I think a lot of people don't understand that the boring is good mindset, because everywhere we look, every media outlet has some big new flashy headline. And so we are conditioned to have an explanation for everything that's happening and wanting to have a narrative around what's going on in the world. And it's hard to take your emotions out of that and to take your view on your finances out of that as well.
Well, like my previous post, and I forget what I titled it, but boring advice. Oh, like, hey, the market's going to go up probably over the next 30 years. It's going to have some peaks and some valleys, but over time it should be up. And there is empirical evidence to suggest that's 100% accurate. But if I was to tell someone that, I sound like an idiot. I sound like I'm aloof to the risks out. I sound like I'm checked out.
But it's boring. No one wants to hear that.
Right. But if I lean in and get right in your face and tell you, hey, my hedge fund contact in New York is telling me that the market's going to blow up in 3 months, and these are the companies that are going to benefit, and you should bet against this asset class, and you should pile into gold and US Treasuries. It's going to save you from a cataclysmic decline. You're going to think I'm some savant and a sage, and I come off like I'm trying to help you. And as human beings, we have an infatuation with pessimism, with the train wreck. And this expands beyond financial markets. Like if I tell you that your neighbor across the street just got married and they're going to be happily married for 50 years, you're like, okay, whatever, that's great. If I tell you that the husband's sleeping with the neighbor across the street and the wife is sleeping with her ex-boyfriend, you're going to want to hear more. I mean, we just have a tendency to like a good train wreck. And you need to be mindful of that because it can creep into your portfolio, and it's not good. So in closing, there is a subtle but major difference in the wealth building mindset, which you've probably have been a part of for 50 plus years, the bulk of your life, and the keeping wealth mindset. Okay. The wealth building mindset, we're taking risks, we're taking on debt, we're trying to grow our balance sheet, we're starting businesses, we're speculating in real estate. That's great. To achieve a successful retirement outcome, you need to do the opposite. You need to be content. You need to check out. You need to be happy with what you've built. You found your enough. Go enjoy your hobbies, your family. Stop the relentless pursuit of more. Stop doing things. Err on the side of doing nothing.
I like how you've framed your balance sheet as being a finished product. There's no more that needs to be done. Yeah. You're in distribution mode, so just quit. That's
a good way to say it. Your balance sheet, when you found your enough, is a finished product.
All right, everyone. Thank you so much for listening to this week's episode of Blind Spots. Check out our recent portfolio review video that we uploaded on our YouTube channel, where we discuss the most common mistake that we see in portfolios and the small change that will help you save thousands in unnecessary taxes. If you're interested in a portfolio review, send us an email to insight@pureportfolios.com. We will conduct a fee analysis, assess your portfolio's tax efficiency, evaluate risk metrics, and potential conflicts of interest. All resources mentioned in this episode will be listed in the show notes below, and we'll see you next time.